All right, you guys, welcome. Doug McKay, anti-wallstreetguy.com on the close Friday, the 27th of January, 2012. For the record, for the sixth Friday in a row, we have the overall trend as long in equities. We are looking tonight at a weekly chart as opposed to a daily chart, a weekly chart of the S&P 500. The Dow had its first losing week, but the S&P has four in a row. Closed again at 1316. Couple different ways we can look at this. We do believe at some point we're going to come back in the near future and test 1300, and at some point we think over the next 6-7 weeks we will come back down and test this 1265 1270 area. But until then, the trend looks good. We could possibly be forming a huge cup where we're going to go back and test the 2011 highs around that 1365, 1370 level. You can see if we were to get above 1350, that looks highly probable that we're going to go higher, possibly to all-time highs. That doesn't mean it's going to happen. We're just going to have to play it kind of day by day, week by week. We do believe if we press up against this 1350, there'll be some selling, and we'll probably build out some type of right shoulder here on an inverted head and shoulder, very similar to this left shoulder, where we'll do some backing and filling. A lot of bullish sentiment right now, which usually is a contrarian indicator. So again, we might see a pullback, but for the record, the overall trend still is intact. Any consolidation that we've seen over the past week, actually over the past couple of days, is actually very healthy. Is it possible short term that we're going to come down to 1300? Probably. This might have been a little bit of a head fake yesterday, intraday on Thursday, to trade above the highs on Wednesday. And then we came down again today, just 2 points down, but up for the week. So we'll see. But again, the trend is intact and go either way. We're not going to give it a lot of room. If we break much through 1300, we will get probably raise some more cash. Conversely, if we trade up here, we're not going to add. We're just going to wait till it pulls in because of the bullish sentiment being so high as a contrarian indicator at this time. Let's take a look at treasuries. What we track is the IEF and the TLT. This is a post that we put out on the 25th. You're only going to test resistance or support so many times. Usually the fourth time you go through it. So we've got 1, 2, more or less 3, almost a fourth. We think if we get around 106, we'll probably pull back here a little bit, and then eventually the next run at it will go through it. As we mentioned here in the post, at this point you might as well just wait till it gets through 106. Could it be a false breakout? Certainly. Our stop would be fairly tight percentage-wise at 104.40. When we open up treasuries to a weekly chart, and this certainly looked different last week, did it not? When we open it up to a weekly chart, we'll kind of clean this up a little bit. You can see that we've broken out of several bases. And again, you're only going to go through so many bases and then the ride is over. But we broke out of a basing pattern here in the spring of 2011. We broke out of a basing pattern here in the summer of 2011. We tried to break out of a basing pattern here. This was a false breakout. We came down, and now we're back up pressing against it. So the reason I bring this up is you're only going to get through so many bases, and then again it's over. That's why we want to have a tight stop in the event that we get long on a close above 106 when we look at it on a daily chart of the IEF. Last week it was a totally different picture where we broke the trend line and we broke down through the 50-day moving average. Obviously the Fed pumped it up on Wednesday. Let's take a look at the 10-year bond yields, and they are now down below the 50-day moving average, and we know that works inverse, whereas last week they were up and treasuries were down. All right, so that bodes well. Quite possibly, like we thought last week or the week before, at some point we might come back down and test the lows on the rates back here in the fall of 2011. All right, so let's now take a look at gold, GLD. Looking at a daily chart, I think it's extended here. We did fill this gap finally. There's a lot of optimism. I think we can possibly run a little higher here. Do I think you're going to get a better entry than what you have in terms of price right now at 168.97? I do. But the overall trend is long. And if we look at this on a weekly chart, which will give us a better picture, we can see that a lot of stops were taken out here. My only concern here, if you were short, was there was so much pessimism on gold here, GLD, that you almost knew that we were going to put in a bottom. Whether that's a permanent bottom or not, we don't know. Technically speaking, there's been a lot of damage here. So there's a case to be made that this is a high, that's going to remain a high, where this is going to be a challenge of those highs, but we're not going to quite break through that 185 and change on GLD or over 1900 on gold. We'll see. But right now, the overall trend in gold is long. Again, I think we're going to back and fill here. I think we're probably going to move higher, test 175, but I'm not sure anytime soon that we're going to be breaking through 185. But the trend is long. Where would we have our stop? Even though we think you might be able to get better prices in the next week, we would have our stop under this 160 level. So we're certainly within range in terms of risk parameters, where maybe that $8, $9, $10 from our stop is within range. I'm thinking just off the top of my head, that's probably right around 6.5%. All right, so we looked at treasuries, we looked at gold. Let's take a look at the dollar, because again, this is almost a week-by-week basis. We had a dollar position in the managed accounts. We let it go on strength here. Once we broke the trend line, this all kind of happened quick. On this day where we had a green candle, we got out. Since then, it has broken down. I'm not so sure that the dollar ride is over, but for the time being, the overall trend is down. So we don't want to fight it. Maybe we're going to come back to this 21.75 level. When we look at, for the most part, the flip side of that, the euro, this is a area of resistance that we drew in a while ago, where we thought that this was highly probable that we would test that. That's also one of the reasons we exited the buck. Possibly the euro could push higher. Again, anything can happen, but this is the first level of resistance we see, and then above that would probably be right around the 135 on the euro. I think if we get to 135 before any type of correction from here, I think it's shortable, and I think we would probably also play a bounce in the dollar. All right, you guys, that's pretty much it. The overall trend is long. We do have some cash sitting in the managed accounts, the 4-minute trader, and also the E-mini model. And we'll see what happens next week. More news coming out of Europe next week, and then also some jobs reports as well. Thanks again. Doug McKay, antiwallstreetguy.com. We'll see you guys next week.